In a move that sent shockwaves through the world's precious metals trade, Washington has imposed a 39% tariff on imported 1 kilogram gold bars, a direct hit to Switzerland, the global leader in gold refining. Earlier this week, Swiss president's visit to Washington failed to secure any relief on tariffs. And now, the latest measures threaten to disrupt a trade network that has operated smoothly for decades. In early August 2025, the Trump administration confirmed the tariff, a decision that immediately rattled markets from Zurich to New York. This wasn't just a penalty on a European nation's exports. It was a statement: no commodity, no matter how deeply embedded in the world economy, is off limits in Washington's trade playbook. For Canada, watching from across the border, it was a warning: if gold could be pulled into the fight, so could other high-value sectors. From a European perspective, the situation was immediate and severe. All shipments are on hold, one trader said. There's essentially no trading of gold bars across the Atlantic until at least the first week of August. Until now, traders believed gold bullion, including the 400-ounce bars held by central banks, the 100-ounce COMEX standard, and the 1 kilogram bars used in Asia, would remain untouched by tariffs. That assumption ended when a Swiss refiner received a formal letter from U.S. Customs citing tariff code 7108.13.55.0, confirming that these bars would face the full 39% duty. The impact was instant. Gold shipments between the U.S. and Europe ground to a halt overnight. American gold prices surged above European rates, opening a new arbitrage gap. According to U.S. trade data, imports had already jumped earlier in 2025. 43 metric tons in January alone, nearly double America's average monthly refining output. Buyers had tried to front-load shipments before any potential policy change. Now, those stockpiles are all that remain to bridge the gap in the global gold market. This is more than just a price spike, it's a rupture in the supply chain. While gold isn't a major Canadian export to the U.S., the lesson is clear: strategic minerals, energy products, and even high-end manufacturing could face the same pressure. Ottawa is aware that even sectors once considered safe under the USMCA could be targeted. This gold shock shows how quickly decades-old trade flows can be disrupted with a single enforcement letter. And with President Trump's emphasis on trade imbalances, Canada's own surpluses in certain commodities could easily draw the same attention Switzerland has now experienced. Prime Minister Mark Carney's strategy is now under the spotlight, while Ontario Premier Doug Ford responds with public pushback and hard numbers. Carney is keeping diplomatic channels open, even as Canada faces a 35% tariff rate in some sectors. His administration is expanding trade ties with Mexico, deepening links with the European Union, and creating buffers to shield domestic industries from sudden U.S. shifts. Canada's leverage is rooted in what the U.S. needs most: strategic minerals, energy supplies, and tightly integrated automotive supply chains. From steel and aluminum to copper, and now gold, the Trump administration is targeting industries where the U.S. can exert maximum short-term pressure. The element of surprise keeps trading partners off balance, pushing them toward concessions before they can coordinate a response. But with Canada, the strategy is meeting resistance. Ottawa is pairing public defiance with calculated diplomacy, signaling that it won't be caught off guard or forced into a poor deal. Meanwhile, back in the U.S., the effects of these sweeping tariffs are starting to hit everyday Americans. From Walmart and Best Buy to household shampoo brands and popular shoe lines, prices are beginning to reflect the new trade costs. When President Trump expanded tariffs to more than 70 countries on August 1st, the goal was clear: bring jobs back, gain leverage, and force new trade agreements. But within days, one Detroit auto parts supplier says the tariffs have left him with no choice but to lay off employees and shut down a warehouse. We went to India to source products, trying to keep prices low for our customers. Now India is hit with tariffs too. Everywhere we turn, another roadblock. It's discouraging, he explained. Corporate America counts the cost major U.S. companies are feeling the sting. In the second quarter alone, General Motors reported $1.1 billion in tariff-related losses. Ford Motor Company followed with $800 million in losses. Even outside the auto industry, the pattern is clear. Stanley Black & Decker, an icon in American manufacturing, projects an $800 million hit for the year. Apple has already budgeted $1.1 billion for tariff costs this quarter alone. These aren't isolated incidents, they are part of a growing trend affecting every sector. Retail giants Walmart and Best Buy have begun passing the costs on to consumers. Everyday items, from shampoo to shoes, now carry quiet, hidden surcharges. Reuters has tracked clear, direct price hikes tied to tariffs. And even your morning cup of coffee may not escape. The United States imports roughly a third of its coffee from Brazil, now also facing new tariffs. Economists warn this may be the moment when the American public truly begins to feel the pinch, as the tariff impact spreads from big-ticket items like cars to everyday essentials north of the border. Canada was hit with a 35% tariff starting August 1st, targeting goods outside the USMCA including steel, aluminum, softwood lumber, and many auto parts. The results have been immediate. In the second quarter of 2025, total Canadian exports fell 13%, energy exports dropped nearly 20%. Alberta, with its energy-heavy economy, took the hardest hit. Rather than respond with rapid retaliation, Prime Minister Mark Carney is taking a different route. Not reaction, but repositioning. Canada is adapting, not just pushing back. The plan: strengthen ties with Mexico, the other major North American trade partner, as both nations navigate a volatile U.S. trade policy under President Donald Trump. This week, Finance Minister François Philippe Champagne and Foreign Minister Anita Anand traveled to Mexico City for high-level talks. The mission: reinforce trade, reset diplomacy, and build a united front with Mexican President Claudia Sheinbaum. Earlier this year, tensions flared when some Canadian voices suggested cutting Mexico out of USMCA. Now, the focus is on realignment, especially with the 2026 USMCA review approaching. Mexico recently received a 90-day delay on additional tariff from Washington. Canada did not. That difference is fueling Ottawa's urgency to lock in Mexico as a reliable line. 2024. Mexico made up only 1% of Canadian exports, a small share, but with enormous growth potential. Meanwhile, the U.S. is seeing economic blowback. According to U.S. labor data, in just 4 months, the manufacturing sector has shed 30,000 to 40,000 jobs. President Trump's approach is straightforward: apply heavy tariffs, pressure trade partners, and bet on American resilience. Prime Minister Carney's approach is different: strategy over spectacle. His government is focusing on trade diversification, protecting vulnerable industries, and strengthening long-term relationships rather than chasing short-term wins. From the coffee beans that brew America's morning routines to the auto parts keeping the nation's cars on the road, tariff politics are no longer an abstract policy debate. They're a kitchen table issue. What began as a calculated foreign policy tool is now weighing on corporate earnings, tightening household budgets, and raising questions about job stability. Former President Donald Trump's trade war once sought to punish global competitors and shift economic leverage back to the United States. But in practice, the collateral damage is increasingly being felt at home. Canada's quiet countermove north of the border. Canada isn't waiting for Washington's political winds to change. Rather than engage in headline-grabbing retaliation, Ottawa is quietly forging new trade and investment partnerships, a methodical, bridge-building approach, while less dramatic than tariff threats. This long-term positioning could turn out to be Canada's most effective strategic response yet. The new target: pharmaceuticals. In one of his most forceful trade announcements yet, President Trump is targeting the global pharmaceutical industry. His administration has unveiled a phased tariff plan, a modest starting rate today, rising to 150% within a year and potentially reaching the 150% in just 18 months. Stated aim is clear: to compel pharmaceutical companies to shift manufacturing back to U.S. soil, strengthening domestic production of life-saving medicines. On the surface, it appears to be a nationalist push for health security. But the scope of the impact is far broader than any single adversary. The European Union, for example, has already been hit with a 15% tariff on its pharmaceutical exports to the United States, a sharp jump from the previous 0% rate. India, one of the world's largest suppliers of both generic medicines and active pharmaceutical ingredients, APIS, is also in Washington's crosshairs. Its ongoing oil trade with Russia has only heightened tensions, drawing the possibility of additional tariff measures. Then there's Canada. It hasn't been explicitly targeted in the first wave of this tariff strategy, but its role in the U.S. pharmaceutical supply chain is too significant to ignore. Canadian companies supply key components, process raw ingredients, and in some cases act as distribution hubs for medicines flowing into American markets. Even without a direct tariff, These deep economic linkages mean Canada will inevitably feel pressure as global pricing and supply routes shift beyond tariffs. Another policy shift could create financial strain for Canada. Under this rule, Americans should never pay more for a drug than any other nation does. Adjusted for GDP, since Canadian drug prices are often about 50% lower than those in the US, the effect could be significant. If manufacturers want to maintain US prices at this cap level, they may need to raise prices in Canada. That could impact provincial health budgets, slow the introduction of new treatments, and reduce accessibility for patients. The European Union also faces its own set of challenges. In July, the US and EU announced a sweeping trade framework involving hundreds of billions in investment and energy cooperation. Yet just weeks later, the US imposed a 15% tariff on European pharmaceuticals, an unexpected move that caught negotiators off guard. For Brussels, this raised an unsettling question: what's the value of a trade agreement if tariff stability can't be trusted while EU retaliatory measures have been delayed for 6 months? The political clock is already ticking. President Trump argues these tariffs will pressure companies to bring pharmaceutical manufacturing back to the United States. However, building such facilities is not like opening a warehouse. It requires years of construction, billions in investment, and stringent FDA approval processes. While industry leaders like Eli Lilly and Johnson & Johnson have announced U.S. investments, these will take years to fully materialize. In the short term, tariffs could lead to higher costs, which may be passed on to patients through increased retail prices, higher copays, or steeper insurance premiums. The global pharmaceutical supply chain is a finely balanced system. Apis sourced from India, high-tech therapies developed in Europe, packaging and distribution routed through Canada. Sudden disruptions can trigger shortages, delays, and cost spikes not just in the US but worldwide. This could be one of the boldest economic gambles of Trump's second term. But by trying to control global drug pricing and force reshoring, Washington is taking a calculated risk with both international trade relationships and patient access to medicines. If not carefully recalibrated, the cost of these tariffs may be measured not only in dollars, but in health outcomes. When it comes to Canada, the real challenge may not come from new tariffs directly, but rather from pricing policies that threaten to push drug costs higher. A critical point here is this: if U.S. officials demand pharmaceutical prices be matched internationally, keeping American prices at or below those of other countries, Canada could be forced to raise its sticker prices. Why? Because, on average, Canadians pay about 50% less for many new treatments than Americans do. That makes Canada a prime candidate for scrutiny under these rules. The Trump administration has pushed a most favored nation pricing policy for U.S. drug purchases. This means the United States aims never to pay more for medicines than any other country. After adjusting for economic factors like GDP. At face value, this sounds fair. But the practical result could be a sharp rise in Canadian drug prices. As manufacturers try to keep U.S. costs low, this isn't just an economic issue. It's about real access to healthcare. Higher drug prices in Canada could place significant strain on provincial health budgets. It might also slow down the rollout of new medications, delaying access for patients who need them most. Beyond pricing, Canada exports billions of dollars worth of generic drugs to the United States. In return, it imports branded pharmaceuticals from American companies. Introducing tariffs or politicizing this cross-border supply chain risks causing delays, shortages, and even stifling innovation. This is especially concerning for Canada, a country that has already faced periodic medicine shortages in recent years. Current U.S. tariff status on pharmaceuticals. It's important to note that, so far, there are no blanket U.S. tariffs on pharmaceuticals. However, as part of ongoing negotiations with the European Union, the U.S. recently imposed a 15% tariff on EU pharmaceutical imports. That's a steep jump from the previous zero tariff level, and it marks a dramatic shift in trade policy. The situation with the European Union remains equally fragile. Just weeks after the US and EU announced a new framework trade agreement in July, an ambitious deal promising hundreds of billions in investments and expanded energy cooperation, the US unexpectedly slapped a 15% tariff on EU pharmaceutical imports. This move caught EU negotiators off guard and sowed distrust. If you're wondering, what's the point of a trade agreement if its terms aren't honored? You're not alone. The EU has postponed retaliatory tariffs for 6 months, but the countdown is on. If tensions escalate further, the entire fragile deal could collapse. introducing more uncertainty to global pharmaceutical supply chains that are already under stress. There's an inherent contradiction here. On one hand, an executive order seeks to reduce drug prices in the U.S. On the other, these tariffs risk pushing prices up. The question now is, will pharmaceutical companies absorb these tariffs, or will they pass the increased costs onto consumers, meaning higher prices at the pharmacy counter? The tariffs proposed, potentially reaching as high as 250%, are too significant for drug makers to ignore. Challenges of reshoring pharmaceutical manufacturing. President Trump argues these tariffs will encourage companies to bring drug manufacturing back to the U.S. But building pharmaceutical factories isn't like opening a retail store or a warehouse. It requires years of planning, billions of dollars in investment, and rigorous FDA approvals. Industry leaders like Eli Lilly and Johnson & Johnson have announced U.S. investments. Still, those commitments won't offset short-term supply chain disruptions. In the near term, drug costs are likely to rise. Companies may pass tariff-related expenses to consumers through higher copays, increased insurance premiums, or elevated retail prices. The very executive order designed to lower drug costs could paradoxically lead to higher prices for patients. The pharmaceutical supply chain is a global web. Active pharmaceutical ingredients app's often come from India. Advanced therapies and research originate in Europe. Finished medicines and packaging frequently move through Canada. This complex system isn't ready for the kind of shocks that tariffs and sudden trade barriers create. Delays, diversions, and shortages could ripple across the board, impacting drug availability worldwide. This may be the boldest and most aggressive trade move of Trump's second term, but it's also one of the most precarious attempts to control global drug pricing and push manufacturing back to the U.S. By escalating tariffs on pharmaceuticals, the administration is risking not only trade relationships with key partners like Canada and the EU, but also patient access to essential medicines. If these policies aren't carefully adjusted, the cost of this trade strategy may go beyond economics. It could become a matter of public health.